Hello and welcome to Money Control. As we get closer to the election verdict, we continue with our series on how to navigate markets during this very crucial period. The election is surely what the market is singularly focused on at the moment, but the important thing is that for markets, it's never one thing. There are always multiple drivers and you can't lose sight of them while framing your investment strategy, whether it is for the short term, medium term or long term. I'm Mahalakshmi and I have with me a market veteran, Devina Mehra, who needs absolutely no introduction, who's going to help us see through how we can navigate the next week, but also beyond that. Thank you so much, Devina, for joining me this morning. And such a pleasure to have you in the studio.
Thanks, Mahalakshmi. Always a pleasure to speak with you.
Sure. So, Devina, first off, what is your assessment of what is the market really discounting in terms of the election verdict?
I think by definition, the market never discounts surprises. So, I think the base case always is that in this case that the incumbent government is coming back. So, I think that much is clear. It's only about how many seats, etc. And as I said, surprise by definition is something that the market or whoever the people at large are not expecting. So what is expected is known.
So if you were to just stack the probabilities, you think probabilistically, right? So if you were to stack the probabilities and see what crystal ball gaze into Tuesday, what kind of outcomes do you think will elicit what kind of responses?
That's all. First of all, of course, you don't know what is the probability of each outcome. I can't say sitting here that I know anything about what's happening in 500 odd constituencies in the country. So, but in terms of, I think we spend too much time thinking about elections and election results. And the biggest upset, at least in my memory, was 2004. Where the incumbent government of Vajpayee was so confident that they actually advanced the polls by 6 months. They said, like, we are sure to win.
Correct.
And you had that India Shining campaign and everybody was convinced, including, I think, the Congress people themselves, that BJP was winning. But then when the final verdict came out, I think something like 60-70% of the cabinet itself lost their seats. So it was a complete upset verdict, and of course the market crashed, and not just individual stocks, the market was circuit down, the trading was halted. But it recovered soon enough, and that the year after that was one of the best years in stock market history in India. So I think the markets have a logic of their own, economies have a logic of their own. So it may not even be that dependent on what happens politically.
Sure. So what is the, again, I know you said that we can't obviously guess what is happening in all the constituencies, but take a guess at what is there a possibility of a surprise at all?
That's what
there might be a small surprise element, but do you see a complete, markets completely jolted out of the comfort zone that they are in right now?
So as I said, Mahalakshmi, surprise by definition is something is a surprise. So
you can't factor this in.
Yeah.
So what you're saying in essence is that we can't formulate a strategy thinking about what could be the outcome. So what should be the strategy then?
So the way I have looked at it, and the way we at First Global are looking at it, and the way our PMS portfolios, for example, are where they are currently, it is very simple. I look at it in like as a two-dimensional thing along if you look at time and if you look at market cap. So in terms of time, if you look at, I remain positive on a 1-2 year basis, and the reason for that is I've spoken about it in the past also, that you had a whole decade 2010 to 20 when the markets didn't do anything at all. The compounding was almost at the same rate as the fixed deposit. So 100 rupees invested beginning of 2010 became 230 rupees in 10 years. Contrast that with, let us say, 1980 when 100 rupees invested became 700 rupees. So that created that gap for the market to go up. And from the COVID lows, of course, we had a rally. But even so, we are not even at the trend line, let alone be very high above the trend line, which is when the possibility of a crash becomes higher. So that's one part. But our systems have been signaling for the last few months that volatility in the interim could be high. So we were actually hedged in March also. Those hedges expired, and of course they were not used because there was volatility, but there wasn't like didn't sustain. But after that, we have again put on hedges because our system still showed that there may be volatility. So, this is the strategy we have done. We are fully invested, we are not in cash, but we are hedged. So, if in case there is a big crash, then our losses or the losses of our PMS investors will be limited. So, that is the strategy we go for, because the way we manage money, we are very clear that risk management first. So, rather than maximize returns per se, we always look at that you first minimize the risk, and within that constraint how much returns can you get, and ultimately you end up making the returns also. So, that's one part. So, this was a time dimension, that when we are positive in the medium term and there may be short term volatility, the sensible thing is to hedge, because the market can also go up as it has been going up of late. And in that case, if you were sitting in cash, you would have missed out on the up move, and you can't afford to miss out on up moves either, because that's the risk of not being invested. We all understand the risk of losses when you're invested, but there's a risk to not being invested. That's one dimension. The other part is that if you look at the market cap categories, so of course, now SEBI is defining those a little differently as top 100 stocks and 250 and so on. But I mean, we look at it from a risk management perspective. So, for us, the thing is that we don't want to be too exposed to stocks below 5,000 crore market cap. We don't even invest at all at anything below 1,000 crore, but below 5,000 also, whereas normally we would be around 15%. We've gone even as high as 20% at times. Right now, we are at only 6-7. So, in the short term, again, it has hurt us because you can see the momentum, but again, we are not there without minimizing the risk. So, that's the frothy part of the market is where I would be careful. So, that includes the very small companies, also some of these IPOs and things like that, because many investors who are new in the market may or may not know this, but the small cap index fell nearly 80% in 2008-9. It came back to that level after 8 years, and that's also theoretical because the stocks had completely changed by then.
Right.
And there was again a mad bull run for 1.5 years, and then 2018-19 again there was a 2/3 fall. So, a lot of people who say that I have compounded 50-60% in the last 2 years or 3 years, if you take a longer term time frame, you will find the picture looks very different. So, I mean, just since many people don't remember the school arithmetic, if something falls 80%, then it goes up 50% for 3 years in a row, you are still down about a third. So, that is something you have to remember. So, always manage risk first. Investing is a loser's game. This is something I repeat often, but it is so true that you win only if you don't lose.
Absolutely. So, this is also for the benefit of our readers. This is also something that Devina has articulated in a column on moneycontrol.com, which you can definitely go and go through, and you should be reading it more than once so that you internalize what she's trying to say. So, two questions based on what you said, Devina. One is how to use hedge, like for an event like this, would you say that, go for deep out of the money put options or something like that? And secondly, since you're saying that the risk right now is in lower market cap stocks, how do you hedge that? Because you don't have a near perfect hedge if you are to take Nifty 50 as the most liquid option. Does that doesn't really do the job for you, or does it in the short term?
No, it doesn't. So, that is the reason why I said that for those small market cap stocks, we have just cut exposure. So, that's we are not using the hedging strategy there. In fact, you can't even really speaking use the stop loss strategy there, because I mean, while you have stop losses, but the fact is when those kind of stocks fall, there is no exit. I mean, it's circuit down, circuit down, circuit down,
right.
And many of those stocks just disappear. I mean, always remember that there are about 4,000 companies that are actively traded today. The number of companies that have been listed over time is many times more. So, many more companies have gone out of business, or at least out of the listed space, than what exists today. So, that's the risk. So, you are right that you cannot hedge those kind of stocks because the only liquid option available is on the Nifty. So, and that's also even for, let's say, our portfolios, it may not be a perfect hedge, meaning you may not go down exactly in sync with the Nifty, but that's the only thing which is available. So, yes, we have bought put options on the Nifty, and at the time we bought it, the volatility index, which determines the price of the put options, was exceptionally low, and we were debating why it is so low, because normally it's not so low going into elections, but this is last month in April. And but we said, whatever reason, since it is low, let's lock it in. And after that, of course, the volatility index has gone up, the options have become more expensive, but we had done the trade before that.
Right. So, another question on small caps. It's very clear, like you also articulated, that in 2008 or every time small caps fall sharply, and usually it's driven by an event, right? Like it could be a big crash coming because of a global financial crisis or something else. We don't know what that event could be now. But without that event, is it possible for example, in the last 1 year, definitely small caps have done exceptionally well, and the appetite amongst retail investors very high. Without an event, is it still possible that a large pocket of small caps can fall significantly, like a 70-80% from here on? Do you see that kind of froth in individual stocks that could derail those stories, or is that contingent on a big fall that will then precipitate fall in individual stocks?
70-80% is a bit extreme. So, yes, for that kind of thing, you probably need a big external event. But I mean, significant falls, yes, they can happen, and the event might even be finding out that there was some scam in two small caps, just as that NBFC problem arose once that ILFS was the first dominant to fall. So, then after that problems came out in several other stocks. So, that can happen, and as I said, small cap, it can be that you find that there was something which was a scam or something not right in some IPO, in some small caps, and then it will become that not just one, maybe there are 5, and then just the sentiment changes. So, it may not be 80%, but that you can have a significant fall, because when the index fell 80%, of course, there were stocks which fell 90 also. 95 also, and almost everything fell. That's the other thing. People think that I'm choosing very carefully, and therefore, my stocks will not fall. But in the 2008-9 fall, out of the small caps, how many didn't fall? 1%. In 18-19, how many didn't fall? 8% only. So, you are not this genius who will be in only that 1% or 8%.
Right.
So, when it falls, sometimes stocks which don't deserve to fall might also fall.
You have already answered the question, but I'm still going to ask the question in a different way. That there is this belief in the market that this time the small cap rally is a lot more sustainable, because this is a cyclical up move in the economic cycle, and a lot of these small caps belong to that category where, whether it is feeder companies or vendors or infrastructure small players and so on. And if this economic cycle were to continue, then you would justify their valuations over the next 3-4 years. The earnings could see a very disproportionate jump, etc. So, is this time truly different?
So, anybody who's been in the markets long enough knows that this time it's different is a refrain that comes every time there is a bull run in anything. But if you look at the macro situation, obviously, see, small caps is not a monolith. They're not all the same type of companies. In fact, the diversity is probably much more than it is in the large caps. So, you do have to look at what's happening in the company, and some of them are regional players where the national dynamics may or may not work. But if you look at the national part of it, if I look at the GDP, for instance, GDP has been running on a single engine, which is government spending. Consumption growth has been exceptionally poor, and which probably also ties to the fact that employment situation has not been very good. So, employment and consumption kind of go hand in hand. So, consumption has been exceptionally poor. Consumption growth has been the lowest in 20 years. So, it's not as if that everything is doing well. There is also an element of, you can call it K-shaped recovery, you can call it premiumization, that you have a certain category of goods doing better, which is the luxury goods, or at least the goods that are consumed by the more affluent. So, if you look at whether it is housing or cars, it is the high end which is selling. So, the high end SUVs and the high end cars are selling, entry level not so much, and so on. So, even I mean, I was so it sounds a little funny, but surprising bit is that even in underwear, that's the story, that the high end is selling. So it's very segmented. So also, as I said, in small caps you have to look at where they are operating, but you can't say that in general the macroeconomic situation is the best it's ever been, and so it will lift all boats.
Okay, so therein comes another question, which is this, this 2 lakh crore bonanza that we've got from the RBI. So everybody is assuming that either you can do it in 2 ways. One is you bring down you go for a more aggressive fiscal consolidation. Second is you step up the capex, right? Is there a third angle to this, which is that you do big tax breaks and you keep the fisc where it is, so you put more money in the hands of people, you go into more aggressively into welfare schemes, and if such a thing happens, if such a thing were to happen, how do you think the market will take to it? Will this address some of the problem which we are facing in the consumption category right now, and how likely is it? From what you have seen of this government in the past 10 years on what they could be doing?
Difficult to say. I mean, of course, this is a one-time bonanza in a sense. It is not that it's
not recurring.
Yeah, that it's not recurring. Yesterday I also saw this thing that now some 600 properties of all the PSU companies and governments have been identified for sale. So maybe that might be another one-time bonanza. So I would think it's likely to be a combination of all of them. I'm sure they will have an eye on the fiscal deficit. Given what the spending pattern has been of late, I would think the greatest chunk will, whatever they want to spend, will go towards infrastructure and capex. But there might be tax breaks, I'm not so sure, but welfare schemes, maybe there might be some increase there too. But I mean, it's speculative. I have no idea what the FM would have.
Even the FM doesn't have, because the FM says the next FM will decide that. So the FM has also not answered those questions in the past. So anyway, so I'm asking this also because for a long time FMCG has not performed. But recently, just in the last 2 weeks, of course, on one day, all the FMCG stocks were up 5%, and that was because of the Nielsen report saying that there is recovery in rural, etc. So when you see such big moves in a sector that you don't see stocks going up and down every day, you don't see is that an inflection point? How do you read into this recent momentum in FMCG?
So FMCG, of course, in 2020 it was the sector, and at that time I had done a half-an-hour program on your sister channel CNBC saying that that FMCG doesn't always do well, and it goes through periods of underperformance, which sure enough came later. So I mean, at some point it will bottom out and start to look better, no doubt about it. As far as the volume part is concerned, like I saw data for, I think it was Dabur, which said that rural volumes had dropped 5%, and then this year they have grown 6%. And I said, that means they are back to where they were 2 years ago, which is hardly, great growth. But yes, I mean, again, the volumes, etc., may have bottomed out, and also depends on the monsoon, and which in turn both directly and indirectly, because monsoon also determines food prices, and right now in our inflation basket, food is the category which is driving inflation to a large extent most months. So if the monsoons are good, it brings down food prices and it puts directly money in the hand of rural consumers. So I would think right now we are dependent on that.
Sure. What is your view on metals? Because the market seems to be very divided. I mean, at least analysts seem to be very divided on metals. What is your own take?
So last about a month and a half we have added in metals. So from being quite underweight, we are now somewhat overweight. So our systems are showing that for now that category is looking good. But of course, in commodities, you can never predict how long cycles will last. For now, it's a positive, also partly because we think China has bottomed out. So in our global funds, for example, we have increased China, so which also has an impact on a lot of commodity demand and therefore commodity prices.
How about global trade setup? Has that decisively turned positive now, because you see US markets also at all-time highs, and unlike about a month back, you have started thinking about a rate cut, at least one this year in September. So does that, are all the signals from global markets also positive, or is that, this is going to be in phases, like, in 2 weeks time, some other data may come and you might still see a pullback?
But actually, if you look at global markets have been good from 2023 beginning, at least the US 2023 beginning, others have.
But a fresh new high is, it sets the tone for continuation of a rally, right?
So, you see, actually 2023 beginning, when the consensus was that equity markets won't do well, I was quite clear that equity markets would do well, because 2022 was not figuratively speaking, but in actual data terms, the worst year in 100 years for asset markets, equities, bonds, everything. So I was quite sure that markets would rally. But I mean, 2023 first 10 months, I was actually quite worried, because the market rallied, but the indexes were moving, but the rally was very narrow. So it was tech all over the world, and more so in the US, where the S&P, let alone the Nasdaq, the S&P 90% of the move was just 7 stocks. But since then, which is about last 6-7 months, the rally has broadened. In fact, now it's broadening further. We see more of the small cap and mid caps also doing well there. So which is all good, because that, the rally broadens, it becomes more robust. In terms of other markets, Japan was the other market which we were watching last year for a turn, and that decisively, our system signaled in April. So since then, we've been overweight Japan. We were watching China for a long time. It gave a number of false starts, but now we think it is firmly now on the way where it will do better. So pretty much equity markets are looking good all around the world. I mean, not all around the world, but there are enough significant pockets where they are looking pretty good. In terms of, the Fed, I mean, that's also, it's a bit of a yo-yo, because when the year started, the majority trade was that the rate cuts would start in March.
Yeah.
So which I was never of the camp.
It was 6 and then it was 4 and then it went to 0.
Yeah, at 2023 beginning, it was that the rate cuts would start by end of 2023. So I was never in that camp, either beginning of 23 or 24, because again, you look at historical data, once the inflation goes that high, it does not come down in a matter of months or quarters. It takes years. So, but I mean, now of course, of course, now central banks also are in that mode that whatever we said last time is of no consequence, only data is of consequence. So there have been enough central bankers who said one thing and then the next time they've done another. There have been those which cut and then raised again. So we're still waiting and watching. But yes, I mean, now that I would think that the cuts would come by the year end, probably. That's the, that's the most probable as we sit here today.
Right. So, so today only on Money Control, we did this story saying that this month, India has seen maximum foreign outflows, foreign fund outflows compared to the rest of the emerging markets. And therefore, and perhaps because of that, but I know that you have said that flows have nothing to do with returns in the past, so I'm not going to make that mistake. But coincidentally, markets have, India has also been amongst the worst performers this month. Is this because of election risk, or is there any other factor?
It would probably be, I mean, if you look at explicit reasons, it would probably be the elections. But as I told you, that our systems have been signaling this for a while. So, I mean, it was just that after that run up, there was going to be a period of a few months where it would be sideways up, down. But then again, I mean, you did make a new high as well. So it wasn't as if that it's been terrible performance or something. So probably you are comparing vis-a-vis China, which is the biggest weight in emerging markets, and that's coming out of a multi-year funk. And surprisingly, somebody asked me this question last night on that the flows are actually coming from China to India, and what does that mean for China and India? So, I mean, flows are not so relevant to track, as you yourself said, that the data doesn't show that if FIIs invest more in India, the market goes up, or if they take out money, the market goes down.
Sure. So, so the reason I asked that question is there a possibility of, because a lot of money has moved out of India in the last 1 month, if we have a good electoral run, does it all come back and gush through like in a short period? I mean, do you see that happening?
Can't
I mean,
say.
is this what I mean to ask really is how much of FII flows for us is now is to do with elections, and how much of it is truly driven by the rate scenario outside in the US?
I think the whole emerging market pie is driven by the rate scenario for sure. So then
So the FOMO money that could come into India, you would not attribute too much to that.
It will. I mean, see, I mean, always I would say investors, even fund managers behave like individuals at the end of it.
They are individuals.
So, I mean, so there's always a lag between when things change and people recognize that it has changed. So China is in that situation. So as I told you that somebody asked me that money is not flowing into China, and but to our mind, China has turned. At some point, people will recognize. By that time, part of the run-up would have happened. It's like capital goods and industrial machinery sector in India. Our system signaled that it had turned in October 21, and we've been overweight since then. But most people discovered it in 2023 when the stocks had already doubled, tripled, and all that. So always, because human beings tend to hold on to the story, and the story is what happened earlier. So they don't recognize often that the thing has turned.
And what are your systems telling you now? I mean, what are you most bullish on if you were to pick top 3 sector stocks, themes?
So we continue to be overweight capital goods, industrial machinery. We've cut back from where we were. So we've been booking profits. We've been shifting from one stock to the other, but we continue to be overweight. We have last year and a half, we have added in auto components, pharma, some construction. So those we remain overweight. Metals is the one where we were underweight, and for now we are overweight. So that would be broadly where we are. Some sectors like banks and FMCG, which were looking very bad now, may not be as bad, but not an overweight call yet. We think IT services is on the other side, where it will bottom out sometime this year. Capital goods might well top out within the next few quarters.
Is it a buy for you now? Is IT services
I mean, we hold it, but we are not overweight.
Okay.
We are not yet gone into
and
the
banks?
Banks, we are still underweight, but we've added a bit from where we were. We were extremely underweight. We have added a little bit from there.
Okay. And this whole, today CLSA has put out this, Modi stocks and stuff like that. So what is your So what's your take? So this Modi pack after Modi will continue to do well?
I don't even know what they have talked about.
So there is a bunch of, all the momentum stocks from, defense to power to capital goods to PSU banks and all of that.
Yeah, so see, among the banks, we still prefer PSU banks. And see, PSUs, otherwise people ask me PSU, I say that's such a broad category. I mean, how do you, there's defense, there's power, there's banks, there's oil companies, they all have different dynamics. So we do have some PSUs, particularly within the banks. As I said, we are overweight PSU banks, but we are not making that kind of call that everything here looks good and so on, or bad for that matter.
Fair enough. One out of syllabus question which I can't resist but ask is, have you been tracking Nvidia?
Yes, Nvidia has been one of our overweights for a long time. And last year when I said that the...
Should we all sell everything and put in Nvidia? Would you recommend that?
No. So we've actually cut in our last rebalance, we cut because we thought, the valuations had gotten a little ahead. So, I mean, on that Mega 7, which drove the entire rally last year, Nvidia was the only one where we were actually overweight, because normally we are not very concentrated. So when, the rally is that narrow, that hurts us. But Nvidia was one we were convinced about, so that was one where we were overweight.
So you're saying the valuation is not favorable right now?
No, but then
but
after that's what I was about to say, because this was before the last quarter results, and they have blown out the lights in the this quarter results also. So I mean, the premise is good. It's a good stock, but obviously you should never go all out on anything.
But you're bullish. Overall, you're bullish.
Yes, overall we like it.
And any of the how about the rest of the pack? Microsoft, Google. Do you like those stocks now?
Yeah, Microsoft, Google, yes, but not
I mean,
everything.
they all look so cheap compared to Indian stocks, and they're
but
tech and AI is a big buzzword.
But then, you know, not all the 7. So we are not, we don't particularly like, for example, Amazon, Apple, Tesla, but we do like Microsoft, Google, and so on.
So I'm saying essentially because of
I
this
mean,
AI.
unlike last year when all these stocks looked good, now you have to differentiate a bit as to what looks good and what doesn't.
So your top 3 will be Nvidia, Google, and Microsoft.
Probably, I mean, I think so.
Okay. On that note, thank you so much, Devina. Such a pleasure talking to you always.
Lovely, Mahalakshmi.